Good morning, everyone. So it's an
Morning.
amazing opportunity to be a guest speaker to the community of entrepreneur that I really, really value because this is where I spent most of my life. So for those one whom I met with and know me, and for those one uh, whom I'm meeting for the first time, my name is Irina D'Amore, and I lead a boutique M&A consultancy that support ambitious entrepreneurs in building and growing with purpose, using a proven M&A playbook to prepare and position and consequently achieve a high impact strategic exit. So I have a privilege. We discussed it with Oli. So I just wanted to have a very conversational with you. So I have a privilege working with entrepreneurs for more than 20 years. So beginning my career as a management consultant, working on private-public partnership projects across the globe, from China to European Union, when at the time we used to be part of. And then over the years, I moved to serve on advisory boards for individual companies and currently hold lots of leadership roles within the community of Institute of Directors, London Chamber of Commerce, and sit also on the committees with different funds, helping once again to fast forward the ideas of entrepreneurs into the real world. So, although my knowledge is very well grounded in this academic foundation, and I'm not going to showcase all the regalies of MBAs and DBAs and all my professional qualifications, because I think the most value where I do deliver the most, it's actually that hands-on experience across the sector and making the difference. So, with that in mind, I just would like let me just start. Can you see my full screen? Yes, I would assume so. So over years working closely with entrepreneurs, I've been really, really privileged to look at the inside the companies, the countless of them, analyzing their finances, engaging with their leaders, and uncovering what really, really drive the success. And what came out of that as a very, very profound insight that most of the great businesses are built to thrive really, really beyond the tenure of any founder. Because inevitably, in life, every business must transition, especially if it is a private business. Time passes, people evolve, markets change, and with that comes opportunity and obviously fresh challenges. So yes, yet while I observed entrepreneurs that are really, really, really often brilliant at focusing on their growth, many struggle to visualize what their end game is, what is their dream exit. And with that in mind, that's the topic I would like to discuss with you today. So as a kickstart of that, I think the starting point of this discussion, I think every entrepreneur need to ask themselves these four questions. And the answer obviously going to be very different to every entrepreneur, but I would like to lead this discussion today, obviously posing that question and giving you the the answer that I have obviously experienced in my professional life. So the starting point, oops, the starting point of that journey of a question is start with my favorite book of Stephen Covey of 7 Habits of Highly Effective People. The cornerstone, I think, of this book is the 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 uh, the habit of beginning with the end in mind. So I think just drawing that, this is obviously all honed into the personal productivity and etc. etc. And with that in mind, I think the example that very kind of lies really close to all of us. I know as being ambitious entrepreneurs, we do kind of channel that ambitious within different domains. And for me, I'm very much an avid runner. As you know, if one prepares for marathon, those strategic decisions that you have to make yourself for life, at least for that 12 months of preparation, it will be absolutely different to those ones recreational jogger that you would consider yourself in a different capacity. So anything that you anything in your social agenda, anything you eat, anything your supplements, how you train, this is all aligned with your end game, that strategic goal of running the marathon. Similar within the organization, when an entrepreneur have got a certain end in mind, so any strategic decision that they make within their company, whether they hire an employees, they are making decision in terms of the capital investment, whether they launch a new product. So every decision will be very, very strategic in terms of alignment to that end goal. So I want to encourage you to think about, or within your own time, when you don't involve in your day-to-day operation. So how do you envisage your end game? So just to give you kind of heads up, how does it look like for other entrepreneurs we're working with? And, I really like to engage a lot of numbers to support our narrative. So statistically, the most common exits within privately owned companies, and that includes whether it is a startup company or you're in a really mature company, been in business for a very long period of time. It is these three most popular ways of exiting your business. It's transitioning to your kids. It's around one of 10 companies transitioning their ownership to children. It's transitioning to managers, internal management team. It's one of 4 or 5 companies. Out of 4 or 5 companies, they usually transition to their management team. And the most popular, I think 2/3 of privately owned companies, they transition to a third party. So and this is where I think I would like to put a lot of thoughts today. So what does it look like? Because obviously there is no right and wrong in terms of how you manifest your end game, but obviously every journey comes with its pros and cons. But as I said, most of the business owners, they do exit to a third party, and that's what we do, is facilitate within our consultancy. So I would like to discuss more in detail, so how that exit look like. So most of the exit to a third party, have got a subcategory of it. So you can exit to an individual. So it's when I'm talking about individual, an individual investor that would like it to transition ownership from one to another. So sometimes, in where we are, we see a lot of, especially in today's world, those ones who are stepping down from their corporate career, and they are looking for that opportunity to once again to prolong their career and working for themselves. Another way of exiting to a third party is just a conventional way. You've heard about that a lot. It's exiting to private equity, VC fund, and family offices. So that exit is not necessarily full exit. So most commonly, specifically with the private equity and VC funds, it's a partial equity where usually 80% of the business either being invested or bought out, and that 20% usually is roll out in a top core companies, and the founder, he has to stay within this investment period that usually lasts around 7 years to facilitate that growth. Finally, this exiting to a strategic buyer, this is where indeed that business owner can facilitate that full strategic exit, is where the the journey of entrepreneurship really finishing at that particular point of time. So each of the subcategories also have got their pros and cons, and I quickly just mentioned that. So obviously, exiting to individual, they usually raise finance, they tap into, in the US they tap in SPA. Here in UK we have various various options to raise money for acquisition, but by and large that comes really with lowest multiplier for an exiting party. Similarly with PE and VC and family offices, this is most sophisticated buyers as well as a strategic buyer. That usually exit takes a longer to go through, and but in this particular two subcategories where with private equity, VC, or strategic buyer, usually the owner getting a maximum value for their business. So the other question, I just wanted to quite quickly move to that, and then I'll take the question at the end of this presentation. So the other question, the second question that comes with that understanding, will obviously we discuss understanding your option, and if that option is obviously looking into the exiting to a third party, the subsequent question that you want to ask is when. So I'm going to move through that. So we want to understand when do I want to exit? So usually in M&A world, we do discuss, in fact, the notion of timing and how important that dimension is for everything business owner. But bear in mind that when we do have this discussion with the M&A, it's mostly driven by the acquired party. So how does it look like to the exiting party? So the exiting party, usually for the acquired party, the bull and bear market usually bears the two multiple the difference. So anybody who is exiting at high, so let's say at 5 multiplier in a bull market, would look slightly different on a bear market. Usually you exit at 3. So we usually have the difference of 2 multiplier. So once again, this is from the perspective, obviously, how it looks like for an acquired party. So if we do talk about the exiting business owner, so let's take the owner that exiting at, once again, at multiplier 5, and the business owner that exiting at multiplier and 3, how it's going to look like. So obviously, let's just take it in perspective of 2007 and 2009. So exiting at different, once again, 1 at 5 and 1 at 3 multiplier. So this is where they exited. And so this is obviously, in today's world, exiting the business entails that you would reinvest the money that you're proceedings of the business. And usually that reinvestment, in traditional term, and we'll get that in a minute in the other few slides. So that just look like investing, obviously, in a less risky financial instrument as bonds and shares. And here, for example, this is the index tracker. So the business owner that exited at 3 and business owner that exited at 5 might yield completely different outlook as we look at the longer term. So the idea behind this is, it's really a good idea to time the market specifically for those one who are looking for that strategic exit. And the way you can kind of mitigate all this risk is just having this readiness to the market. I do have actually this conversation a lot with business owners. They say, the discussions are usually going about, oh, well, I will exit when and ... whenever I'm ready, whenever I have a right number. But how do we know that? How do you know that you're ready? How do you know if you have got, the right number, if you haven't actually looked into that and have some kind of degree readiness for that strategic exit? So another thing that I talk about a lot, that usually strategic exit is not an event. The strategic exit is a journey. So it is something that you really need to plan in advance. And once again, understanding your option, what we discussed first, understanding when do you want to exit. And the next question that I would like to address, that also come very often in my discussion with entrepreneurs, for how much. So how much I can get for my business. So unfortunately, unfortunately, so the categories of entrepreneurs that we are working with, it's from startups, scale ups, and step downs. So the most I would say the awareness we have in terms of understanding when and how much and what options available is those sorts of startups. Because we always say that those startups, they on the clock, so they obviously have got investors bought into their business, so they are on the clock to deliver that. So anything, that decision that they make, it's very important, because once again, time is not on their side. So how much, this question, with startups, they know how much they're going to sell the company for at the conception of the idea. So once again, the conversation I usually have with business owners, understanding their market, understanding their product, understanding the difference it makes on the market, and etc., that all contributes to that how much. But I just gonna give you just kind of a heads up. So usually how it looks like. So this is the median of what we call the multiplier. So in merger and acquisition, what we call the price to EBITDA, which is a multiplier that what traditionally is used to value the businesses. So this is how it usually looks like. As you can see, so if you sell it to private buyer to private seller, this is usually the multiplier. And once again, this is an average. So obviously that works across the sector. And I'm going to give you a bit of a breakdown how it works across the sector. But this is basically where you get what you get. So, so 3.8, that's where we usually average in terms of the exiting multiplier. And vice versa, look at for example, public buyers, public sellers. So we will be discussing in terms of strategic acquisition. Is it there for me? So as you can see, the difference is huge in terms of usually strategic buyers. They really pay over the market price in order to fulfill their strategic goal. So this is how they break down. As I said, it's just a snapshot. So obviously there are many industries. So as we work with the US, we usually use ANACES as a standardization of industry sectors, but it's very similar in the UK as well. So on average, so if you can compare across the years and across the sectors, this is usually what it averaged to 3.8 multiplier. So it means that the EBITDA times 3.8, that usually the value of your business. However, you probably come across, so this is where we are on average, but the standard distribution has got the obviously the tails. So where you want to be as a business, you don't want to be on that side of it, that standard distribution. However, you have an opportunity to be on the different side. So the businesses that have got really, really strong fundamentals, and this is perhaps a discussion for another day, they do yield a high multiplier. So we might see the businesses even within the same industry with the same EBITDA, but completely different fundamentals, that would be considered as a best-in-class business, where something is very average. So once again, when we consider that the valuation, and the valuation do come very often in discussion with business owners. So there are, three kind of elements that goes into that valuation. So the company itself, the industry you're in, and the country you operate in. So obviously where your operation, and it's the multiple countries we do consider actually the risk rate for that particular country. But where I'm getting at, so most likely you have less control of the country you're in and industry you're in, because it's had kind of been historical. However, you do have control of how your company operates, and once again, within this, improving your fundamentals is most important element to improving your multiple. So as we discussed, once again, the options are available to you to exit, understanding, the timing, when would you like to exit, also understand to how much you can earn from that particular exit. We want to kind of go to the last question, that four important question that every founder would like to ask themselves is, how close you are. So this is another very important element. So understanding, obviously mapping out all the options of your potential in terms of the exit, um, uh, uh, the timing when you want to exit, what it can yield in terms of proceeding. You also want to understand your financial and personal readiness to that exit. So that what comes is, and I'm really sorry about being very geeky about these numbers. So, but this graph is shows to you. So if you, for example, invested the proceedings into this is so, for example, 70% portfolio of stock and bonds, which is considered a safe portfolio as a retirement fund. So your withdrawal rate at 9% will basically prove more failure than your withdrawal rate at 3%. And that's, no, I'm not a financial advisor, but this is something that you would like to engage with to understanding. So, and the safety options in here usually how understanding how close you are to that exit in terms of obviously using that proceedings to fulfill your lifestyle, is to understanding how much you need to invest in order to yield that annual, for example, return to fulfill your lifestyle. So we're going to be using that 3%, which is 33 years. So to understand, and once again, this is very much is just for illustration purpose only, for you to understand how you might bounce some ideas once again with yourself, if you're financially savvy, or perhaps with your financial advisor. So understanding obviously how much you need in total to withdraw at 3% as your pre-tax income. So subtracting if you don't have any other investments, etc., and subtracting and adding investments, subtracting debt, and understanding the net asset outside of the new business. So understanding this net asset outside of the business, getting you what we call it the freedom point. The freedom point is how much money you need. Once again, adding that investment that you have outside of the business to subsidize your lifestyle. So once again, drawing on statistics. So Exit Planning Institute postulate that the business owner who owns the business with 5 million turnover onwards usually have got 80% of their wealth invested into that business. So obviously, the business becoming an asset class and the main contributor to that freedom point calculator as you go along. So you might consider that as you do your own calculation. So, and also obviously exiting the business entails some of the frictional cost, as we call it. So you need to understand, once again, this is all for illustrative purposes. You need to understand how much you will pay in terms of facilitating that exit, legal costs and taxes, and etc. So that is obviously this 32%. So we want to understand, so that our freedom point was at 2.680. So we're adding this 32%. This is basically what we call it, also a magic number. So you want to understand, once again, what do you need in the end as your nest egg to go backwards and fulfill that number with your asset class as a business. So drawing this picture and actually helping you to guide you through to the answer to those questions that I've posed. Now I want kind of to home it in terms of, so what we do within our practice, and how do we help business owners to navigate that that strategic exit with their entrepreneurial journey. So we what we do help, and I said, you know, there are business owners that and founders that in position to facilitate themselves, but in my experience, the strategic exit comes as a team sport. So usually you do need to have, whether it is your internal support within your management leadership team or external support that helps you to get to that your destination safely. So we do once again accelerate the path to business exit success of very ambitious business entrepreneurs. So what do I mean by that? So we work with a group of startups, scale ups, and step downs. So with the startups, those ones who are already on the market, product market fit, and usually what it's related in the tech business as raising their A round and onwards, looking into once again growing organically or inorganically. The same with the scale ups. So looking uh, uh, to really fast forward the strategic growth by growing their top line and looking for that strategic acquisition. And equally, we work with a lot of very mature entrepreneurs that at the time start perhaps the businesses with a very modest idea of fulfilling their lifestyle, but grow to a point of 50 to 100 million in turnover and looking for that transition. So once again, this is very ambitious entrepreneur within the what we call a low mid market, from 5 million in terms of turnover to 100 million. And if we're talking about startups, so we have those ones at 8 to 10 million at pre-money valuation. So you know, it's a kind of a bigger, a very big picture that I draw you. And you know, one might ask, so how that it all come together. So the way we actually pioneer the solution to that really silent problem of not understanding your exit is working with entrepreneurs, what we call it on their dream exit strategy. Dream exit strategy, it's a 5-step process of a fusion framework of combining traditional M&A approach with pre-transactional consultancy. So what we have discussed in terms of understanding your goal objective and starting from your end game, or also understanding your options, because obviously not every business is suitable for private equity or VC, or vice versa. Some of the businesses, they're not suitable for the strategic buyer. So we do help business owners to understand, you know, how to map out that exit. We also help them to understand their readiness. So the gaps. So what we discussed with you in terms of understanding how close you are, how much you need, obviously, to make any difference within your business to get to that destination of having enough income to subsidize your lifestyle. So that usually comes with the pillars of personal, financial, and business readiness. So we don't do it in-house, but we do work with wealth managers and financial advisors, a tax advisor who can help you to do that. And we actually focus on the main asset that you have on your books. It's your business. So the third step of dream exit strategy is enhancing. So understanding obviously your goals, objective, and understanding the gap and bridging these gaps. So obviously for every category of our business owners, from startups, scale ups, and mature businesses, that would look slightly different. There's somebody looking to maximize the value, somebody looking in the repositioning, somebody looking for that inner organic growth to get to the size where they are really a palatable target to a third party acquire. And finally, so once this is all complete and the playbook of business owner understanding their terms and vision is completed, we only there and then moving into engaging with the market and structuring the deal. I spoke with Oli about that, giving you case studies and everything. So all of our businesses, in fact, never go on a public domain in terms of their exits. So we have close relationship with private equity, family offices, and VC funds across the globe. We're facilitating the exit of UK companies, but obviously they do have access to a global strategic buyer domain. So, for example, family offices usually we have in Middle East. We have funds that interesting, and in today's world, even private equity fund, they have got their own strategic intent. So we do understand that one, including strategic buyers who is currently looking for that power growth and looking for acquisition targets. So we do match at that stage, and at that stage we also facilitate that due diligence and integration process within the relationship between seller and buyer, and helping to get that transaction across the board, across the finishing line with the success. So final stage of monetizing, this is once again where we settle everything. Everything is loops back to our goals, objective, and fulfilling that everything has been decided on the defined stage, loops back into that understanding the proceeding of the transaction, understanding the deal structure, and understanding integration that contributes to a success of that transaction. So we also slightly different to what we do to other M&A firms. So instead of having any of our advisors, so this is just give you an outlook how do we work with our entrepreneurs. So all of our services are productized, so you never get an advisor sitting on your book on a retainer. So every service that is delivered has gone input and output and a timeline. There are specific stages where we work with entrepreneurs on basis of do it with you, and there are stages that we do it with for you. So, but once again, this is very kind of goal-oriented and action-driven approach that allows everyone to have this transparency of what is delivered. I'm not going to go into more details of that, but anyone who is interested in a more detailed approach, obviously every stage would look slightly different for different category of entrepreneurs we serve, from startup to step down. But this framework really delivers success to both parties, because in today's world, it's only 50% of mergers and acquisition are actually successful. It's within season and M&A companies. So we're trying to break that the boundaries and try to deliver every successful transaction. So the process we engage is quite simple. So I think I would encourage you to once again bounce some ideas, perhaps with yourself, with your co-founders, to think about those trigger questions that I've covered at the beginning of my presentation. But if you would like to explore if you are a good candidate for that strategic exit, I think the first thing first, we would like to have a business assessment with us. So we're going to deliver value whether you are a good candidate or not, just giving you the mapping of how it looks like for you. The successful candidates usually invited to that strategy and action discovery call. We will go in more granular details, so what it entails for you. And once again, once we are on the same page in terms of your goals and objective, we onboard you to start this journey with us. So once again, if you want to explore that strategic exit, you can scan this code that give you access to our Exit IQ questionnaire. That is a first step to understand where do you score in terms of your potential strategic exit. So now I would like to open a floor for Q&A, which is usually my favorite part of any talk I give.
Thanks, Irina. Do you want to stop sharing your screen and then it'll open up the floor to everyone? That's it. Has anyone got any questions for Irina?
We have loads of questions, but no time to ask those questions.
No,
No.
you got plenty of time.
Get on the call with me. I'll be happy, you know, I'll be happy to kind of power start that conversation. If it's something, once again, if it's more generic, obviously this is perhaps a floor to discuss that. But if you have got any specifics that is, once again, tailored to yourself, to your business, and etc., I would encourage you to get on the call with me, and we will be very happy to discuss it once again on your terms.
Yeah, all righty then. I'm gonna take up that option, because you threw so many questions, or you opened up so many questions with the short presentation that is it could be opening up other avenues that potentially I had not considered before. So
No, that's okay. Give us one of them, Giancarlo. Anyway, just so that you.
no, I mean, it came from the on the end game. What's the end game? And then you talked about the roadmap. The expression that came to my mind was to do some reverse engineering. So if we're talking about the exit, what's the exit criteria? How can I reverse engineering a roadmap to get from here to there? So. But that is like a, a question to discuss for a lengthy period of time, to go through all the details and obviously explaining the situation to Irene about it.
Okay, that's cool, Giancarlo. If you get in touch with Irina, and going over to Graham.
Hi, good morning. I'm sorry, my camera's broken, so you're not going to be able to see me. But no, thank you very much for a very clear presentation. A few questions, but typically if you're looking, which I currently am actually at exiting, we have a scale-up business with a proven product market fit. What are the typical fees and timelines that your business would charge, going through the whole process from the review all the way through to concluding a deal? So timelines and fees.
So if I assume that you are a startup on the product market fit, so usually we do engage with startup, what we call it, and I'm not going to bring that presentation back, but what we call it ACO deal. So it's at the kind of on a turnkey. So this is the time where startups sit on our books for a really long period of time. So the timeline from round A to a strategic exit is around 7 years, 5 to 7 years. So we do build those valuations because we do consider we build into valuation the way you exit in your business. So this is 5 to 7 years. So as I've mentioned to you, so depending where you are. So I do usually within the ACU deal, I do sit on advisory board. So that is 5 to 7 years in terms of your exit, and the success fee usually is 5% to where we are. But within that 5 to 7 years, you do have access to different phases, so different products. What we do in terms of building your, for example, roadmap, which is in traditional what we call is business plan. So this is one way of one price tag for that. Then engaging with implementing that strategy that we set up for you, whether it's in-house working with you directly or you engage with external advisors. We have got advisors that can help you to do that. So once again, this is really the question I need to answer once we do have a roadmap for you, what is just it entails for you to exit. But by and large, so there's a product type service which is priced separately, and there's a success fee of 5% that we charge at the end.
Okay.
I mean, just once again, if we engage on the call and I can look at the specifics where you are, and I also need to understand industry and how you envisage your strategic exit. So I can give you more specifics on that.
Okay, now I will pick up with you directly, and thank you for that. I mean, just in terms of our business, so we're in scale-up mode. We're profitable. Our revenue is probably around about 10 million. But we are looking for that strategic exit. So typically, do you charge ongoing fees while you're doing yours? So it's typically a 5% fee on execution or sale execution.
So once again, there is no retainer, so we don't do the retainers. So anything that needs to be done. So we start with a roadmap for you. So for example, building a plan. It's it's 10K. We build the plan for you with all specifics of what you need to be done. Then there are options. So it's not a retainer. It's action-driven goals. So it's specifically. So for example. We work with companies, specifically with startups, when they're doing their pilots or when they're doing just marketing. So we're specifically, every task is priced separately. So, and once again, this is not a retainer, this is a goal oriented. So usually we align it with the fundraising, because we get involved with startups quite early. So if you're fundraisers, we usually bring in people within a certain domain that once can help you to get from A to B faster. And what we do charge as a success fee, as I said, is a 5% at the end. But we do not have retainers. So that 5% allows you to have me as an advisory board to guide you through the whole process as you go along.
Okay, thank you. Very nice model. Also, do you have any sector specialities? Say, I don't know whether it's telecoms or, I don't know.
I'm asked this question very often, and I always respond to that. So, I usually give an answer to that with Socrates approach. So I can tell you what we are not working with, and then the rest is obviously there. So we are not working with retail, we are not working with manufacturing, we are not working with construction, we are not working with property portfolio. Anything else we would consider. Most importantly, bear in mind, I like, this is what I call ambitious. You absolutely rightly pinpoint that. We reverse engineer that. We usually work with the industry that is really, for any fragmented industry. So when we're talking about brick and mortar, any fragmented industry. So recently we're doing lots of roll-ups for HVAC or green energy, for example. So anything that is fragmented is a really, really good candidate for that strategic exit. And vice versa, the industry that is in decline, for example, transportation, or an industry that is asset heavy, manufacturing, is difficult to predict the returns. This is industry we are not working with.
Thank you. Thank you for your time. It's really interesting.
Thank you, Graham.
Over to Finn, who's got a question. And Finn's doing the, oh no, you're not muted, but your voice is not coming through.
We can't hear you.
Nope.
Can you hear me now?
Yes, we can.
Yeah, we can hear you now, Finn.
Yeah, you might have just answered my question, actually, but I'm a property developer, actually, so it's different from a property portfolio because, in effect, we are a operating partner to investors, and it's more of an operational business than just taking rental cash flows. But it is SPV focused, so our profits are driven by deal flow and are not really recurring EBITDA profits. Do you see, how do you see, are there any exits that you see from businesses that are structured like that don't have a regular, fairly predictable profit? Or do you generally see those kinds of businesses they just strip out the profits from each project as they go, and then at the end, basically the company's not worth anything?
Yes, that's absolutely right. This is where we go back to fundamentals. So there are fundamentals drivers that attract the investors. So within the portfolio, when I've mentioned, not property, we do work with property. But once again, this is the businesses that they have what we call a moat. There is a secret sauce behind it. Within the property, we do have. So for example, data warehouses. So flipping the property into the care homes. So this is something is a quite interesting proposition. And usually those candidates, and they're not traditional, I would say, property portfolio, but it is a business that would generate that what we call a recurring revenue, because anything recurring can be really predicted down the line. Usually candidates of that caliber is a very good target for family offices. So family offices, they're looking for that opportunity where they capitalize on their bottom line. So when we talk about private, this is once again kind of heads up. So private equity looking for something that is capitalizing on their top line. So when fueling the growth, family offices is looking for something that is capitalizing on their bottom line. So any businesses, once again, but I really see something kind of exciting in terms of the property, what you're saying, unless you kind of reinvented something within. And once again, I've seen some of the interesting projects within actually green energy, where there is some element of underground heating pumps introduced. So there has to be an element of innovation in there. So this is where would be also interesting if you do have some idea. There are options. I'm not quite sure. Once again, this is very much a tailored advice whether you are in position to pivot. And that's what positioning and repositioning is also part of that strategic M&A. So this is where you actually, what we call the reverse engineer, understanding what is in demand and trying to reposition it slightly. So we've done it before. We repositioned from, and it's not within the property, and I'm sorry to say that, but that also kind of yelled. So we repositioned from distribution to e-commerce, from 2 multiply to 10. So this is where, once again, where our secret sauce is. I would be very happy to get with you once again on that one call, so we can go more in depth with some of your ideas, and maybe we can contribute to your ideas with our insights, what we do see as in the domain of what's happening within M&A at the moment. So the other thing I just wanted to mention to you, and I'm sorry, I'm just within your question. So traditionally, in order to get on the radar of private equity firm, you had to yield around 10 million in terms of turnover to be, once again, this palatable target. In today's world, with really kind of pioneering of roll-ups, this is not a trend anymore. So anyone who has got business even below 10 mil, but they are within fragmented industry or sector, please get in touch with me and I can confirm whether you are or not. You would be very interesting. So those ones, I've mentioned to you, HVAC, health and beauty at the moment. So lots of laser clinics being rolled up. So even if you're a traditional business that doesn't have that huge potential of growing with like 25% with their bottom line organically, we still can help you if you are positioned right within certain industry sector to be part of that strategic exit.
Thank you. That's helpful. I'd love to follow up with a call, Irina. Thank
Absolutely.
you.
Thanks, Irina. Any more questions before we wrap up?
Hi, Gary. I was just going to say something if I can.
Yeah,
go. Hi, Irina. Good to meet you. Thanks for your presentation. I joined with sort of interest when I saw the invite for this one, with sort of and coming here sort of wearing 2 hats really. My primary business is a fractional CFO service, and I've been involved in exits and M&A businesses and supporting due diligence exercises. Generally, they've been my long-term clients, and we've prepared for sale and dealt with that. But also I'm a director of a medical devices company as well, which is preparing for sale. And we are doing some work around that. And valuation is something that's been quite an interesting discussion. And I I'm sort of more pessimistic with a sort of my FD hat on, and the owners or the main shareholders, I'm a minority shareholder, are a lot more optimistic. And we've had some sort of guidance in that specific industry where the multipliers of EBITDA are quite wild. I put a link to my profile in private messaging. I don't know. This is the only time I ever use Zoom, so I'm not too familiar, but hopefully you've got that. If we could connect, I'd really like to sort of understand evaluation.
I can help you to resolve that dilemma. You know,
Okay, great.
as a kind of giveaway, we do build scenarios, so it's a sensitivity. So, you know, obviously, and it's very common to have those gaps between founders thinking about something as really kind of unachievable to you, obviously, to something because you're within your lane. So basically being very conservative. So there could be some gaps. There is a scenario building, and once again, that valuation comes with a lot of what we call commercial due diligence. So instead of just saying it's not really realistic, we usually bring a lot of data because we have access, obviously, to existing transaction, we have access to public companies, we have access, obviously, to looking under the hood of what's happening within specific sector or industry. So we can actually trade those, once again, insights and facts to business owners where there is a bit of understanding why, you know, we would consider a very conservative evaluation not to trade the company on a discount on the next round. And I'm telling you, this is a scary thing.
Well, if you can connect with me, that would be great, and we can follow that up. And
Absolutely.
yeah. Okay, that's all for me. Thanks, Gary. Thank you, Irina.
And after this call, we'll be sharing all the details, the video, and sending Irina's contact details to everyone as well, yeah?
Thank you very much.
Irina, I think that's the end, unless there's any more questions. I'd just like to say thanks a lot. And Irina, I think we should definitely look into doing another talk soon because I think everyone enjoyed it and got lots of value from it. So thank you very much.
Thank you so much for giving me this opportunity. I will be delighted to cover some of the, for example, points that we have discussed as a Q&A. For example, valuation and also fragmented industry, something of that, because this is a topic on its own kind of standalone basis. So I would be very happy if, for example, your community can submit their preferences in terms of, obviously, today's discussion was very on a high level. I will be happy to plug in with a specific domain and give you more data, more insights, and more knowledge that would help you once again to make that strategic decision on your day-to-day basis.